Are higher Treasury yields after Wednesday's Fed cut really a red flag? And should you sell your Treasuries now? Hello everyone, I hope you are healthy and well, and welcome back to Markets with Marcus. So we discussed on Wednesday how long-term Treasury yields went up even after the Fed cut its rate. Now, this caused alarm among some observers, and for example, my LinkedIn, to take just one example for a social media platform, lit up with messages like this one. The bond market rejected the Fed rate cut. The Fed lowered its policy rate by 25 basis points for the first time in 2025. So, the benchmark 10-year bond yield should also have gone down, but instead it rose. So, I won't repeat our video from Wednesday, but let's look at 3 questions today that also came in from some of you in our community. First, are higher Treasury yields after Wednesday's rate cut really a red flag? Or what else could explain it? 2, how was it in the past when yields went up after a cut? How long did this uplift last? Or did yields come back down crashing after a while? And 3, what does that mean for you and your Treasuries? So, let's start with the first questions. Are higher Treasury yields after Wednesday's rate cut really a red flag? Or what else could explain it? So, let's start with a basic observation. I think that most of us on this channel should be familiar with. So, higher yields in themselves are neither good nor bad. It all depends on your perspective. So, when the government is issuing Treasuries, they clearly want lower yields. They want to pay less for their debt. Whereas the Lama family, when we're thinking about buying Treasuries to put into our NestEgg, we want higher yields. We want a higher return on our savings. So far, so good. Business as usual. Now, the good thing for the government is when they issue bonds for the first time, at least they control the yield, at least to a certain degree. But they can pretty much set the coupon, the yield on Treasuries that they sell as much as they want, as long as they find enough buyers. It gets more complex though when we look at developments in the secondary market, because the Fed does not control the longer maturities. So the Fed rate, the rates that the Fed set on Wednesday, will heavily influence short-term Treasuries, especially T-bills, because they're very close to short-term overnight rates, but longer-term Treasuries will have their prices, their yields, determined by supply and demand. Because in bond land, as always, the basic mechanism is price up, yield down, or price down, yield up. Meaning in other terms, when you have more buyers, it gets more expensive, the yields go down. If you have less buyers, the prices drop, the yields go up. So, when we keep that in mind, we know one thing for sure of what happened on Wednesday. People, investors, traders must have sold bonds, or at least bought less Treasuries than they usually do, which means the price went down, the yield went up. That's what we saw. And we know that for sure. That's just how markets work. But what we don't know for sure is why people sold the Treasuries. Because the market doesn't tell us why they do something. Now, individual traders may give you a sentiment, and you can gauge the sentiment, and a lot of people do that and makes a lot of sense, but you never know whether it's fully representative. The market is a big beast. No? Will some voices always be able to speak for everyone? You don't know. And in any case, money speaks louder than words. No? So fact is, people sold bonds, yields went up. So to interpret what this really means, we need to think for ourselves and apply some of our own guesses or analysis if you want. That's not always easy. Markets are complex. And on top, if you look at all the voices around in the media and on social media, sometimes it's hard to make sense of it. And maybe some commentators sometimes also have a tendency, conscious or unconscious, to think about their own pockets, or maybe look through a political lens. So let's take a step back to figure out what are the principal reasons why fundamental investors could have been selling bonds on Wednesday. Now, the two main motivations are really a negative or positive sentiment. So one reason to sell bonds on Wednesday would have been a negative sentiment. You thought the Fed cuts would make it worse. You may have feared that the Fed was losing its independence, weakening its anti-inflation stance, and prices would continue to go up after this first rate cut, and maybe many more would follow. And you might also have been losing your trust in Treasuries a bit as a consequence of that. Maybe you even thought that this didn't bode well for the long-term credibility of Treasuries. So, negative sentiment, you want to get out of Treasuries. Yields go up. But there's an alternative explanation why yields went up, why people were selling. Because if you thought that cuts may work as intended, then it's possible that the Fed balancing act between unemployment and inflation might just work, that we will somehow muddle through, so to speak. We will not get stuck in an entrenched stagflation. The economy may revive, and overall, the economy will keep growing. We won't see a recession. So if that's your assumption, then equities and other alternative investments, but mainly equities, what we look at, would be more attractive. This would not be the time to buy Treasuries for safety. You would be missing out on equity returns. So the positive explanation, if you want, the positive sentiment behind selling Treasuries would be that the rate cut will revive the economy. If you want to participate in the revival of the economy, equities are better bet. So you sell your Treasuries, you buy equities. And by the way, maybe if the economy revives and it takes a bit longer to get inflation under control, there will be a bit more inflation as well over time. This also would speak for higher yields. So there's definitely both possible, positive or negative sentiment. Both could lead you to sell your Treasuries. But we also know for sure that one thing was definitely not a motivation on Wednesday, because no one was buying Treasuries. So if you were thinking a recession is around the corner and you want to park your money in Treasuries as a safe haven, you would have bought Treasuries, which would have pushed yields down. That clearly didn't happen. So that's clearly not an explanation for what happened on Wednesday. So you probably wonder, what do I think, what do we at NestEgg here think? And we lean on the positive side. So we think that it was more the positive sentiment that impacted the development of the long-term rates. So more or less, Fed may balancing, it may just work, maybe we just muddle through, or maybe there's even still some hope for that. And maybe, yes, we may have an inflation rate that is higher than 2% for a while, but that's why people sold, that's why yields are up. And by the way, the yield increase wasn't that large either. So it's a bit of a muted positive sentiment, if you want. And in our view, this explanation of a positive sentiment is supported when you look at the equity markets, because they were up for the week after the cuts, which is consistent with the assumption that the Fed cut will overall help the economy, or at least not hurt it, maybe keep inflation a bit higher as well. So people were buying into equities as well. So maybe people were selling their bonds, buying equities. That's why now bond price is down, equity markets up. But again, that's our interpretation. No one has a crystal ball, not even the Fed, I'm told. So no one knows for sure. Market sentiments may also change over time. So we'll need to see how that develops in our case. But this also leads us to the second question. How did it go in the past when yields went up after a cut? Did this uplift last? And for how long? Or did yields come back down crashing after a while? So keep in mind, past performance is no indicator of future results or returns, as always. But with that said, let's still look. It's still interesting to see what happened in the past in 3 episodes. So here on this chart, for those of you who can see it on your screen, we plotted the Fed funds rate and the yields on 10-year Treasuries for the 10 years between the 1st of January 2000 and December 31st of 2009. So an eventful decade for our financial system. So the blue line with the many little ups and downs, that's the yield on the 10-year Treasury. And the dotted green line, it's the effective Fed funds rate. So we didn't show the whole range. That's just if you want the actual average of where it really stood, both supplied by the Fed itself. So the first thing you see when you look at that is, in a way, that your long-term yields on the 10-year Treasury are really not really following directly what the short-term Fed funds rate does. So if you look here, maybe between 2000, 2004, and then again after 2009, you can see Fed funds rates went down dramatically, steeply, but the yields for 10-year Treasuries remained elevated. So it confirms what we've been saying. The long end of the spectrum is controlled by the markets, not by the Fed. So let's jump in now in the first episode around the year 2001, 2002, the famous bursting of the internet bubble. And you see the gray shading here. The gray shading means that the US economy was officially in a recession. And you see that then later again in the global financial crisis as well. So when you look at that, what you see is, if you want a classical recession picture, Fed starts cutting rates, and initially, in a way, yields on the 10-year start going down as well. So that means both the Fed and the market probably expected a recession. Fed started lowering rates to counteract it, but people were buying Treasuries, the 10-year in particular, as a safe haven against an inflation. But then, somewhere in early 2001, you see this little spike here, and that just could have meant that at this point maybe people thought, oh, the worst is over. Fed continued to cut rates, but 10-year yields went up. So people maybe thought, oh, the worst is over. Maybe I go back into equities. And maybe we stabilize again. Well, now this lasted for a while, it went up for a while, but then it started trending down again, and actually the downward trends in 10-year yields continued until the recession ended in late 2001 officially. So clearly that's like the safe haven of the Treasuries. Then the next episode is a bit more upbeat. You see here around the middle of 2003, the yields on the 10-year Treasury had been trending down for a while, but then the Fed lowered its rates. Didn't lower it much. This looks like a quarter percent, 25 basis points. But in this case, yields really jumped up on the 10-year Treasury directly after the cut. Again, if you look at positive sentiment, this could again imply that traders were selling Treasuries in order to invest in equities because they felt that the economy was stabilizing. And if that was the bet, it worked out. There was no recession, no gray shading. And in the following years, until the great financial crisis, the 10-year yield stayed at a relatively high level and there was no recession. So in this case, the jump of yields after the rate cut was a positive signal and was confirmed. And then finally, the third episode that I thought we briefly mentioned was in the great financial crisis, this long shadowed gray here from late 2007, early 2008. For those of us like me who lived through it, I think we remember. You see here first again a classical development. Fed starts cutting rates, yields go down, safe haven status. Then it becomes more interesting. Fed keeps cutting rates, yields stabilize. Maybe people think we're going back to normal. But then suddenly, around the middle of 2008, the Fed starts cutting rates again very sharply. And yields on the 10-year Treasury go up a little bit, but then really almost collapse. So this is a oh no moment, maybe, where traders might have thought that, oh my God, it's worse than I thought. Is it really that bad that the Fed has to enact these emergency cuts? And again, they probably saw Treasuries as a safe haven where they then parked their money, pushing yields down. And indeed, it was more or less the bottom of the crisis. So to summarize what we've just seen, whether yields go up or down after a rate cut, we've seen everything in the past. We've seen the 2001 recession where yields initially go up after a cut when the market thinks it gets better. Then they stay up for a while, but it doesn't really work. The recession drags on, yields start going down again. We saw 2003 where there was no recession. The yield goes up after a rate cut, and it stays up. That's clearly what we all hope it will happen this time to avoid a recession. And then you had the global financial crisis, a deep and long recession. And there you had a moment where when a rate cut by the Fed really initiated a, oh, is it really so bad moment? And yields on the 10-year also went down a lot because people were fleeing for safety. And the main lesson learned is how yields will develop on treasuries, especially on longer-term treasuries, will mainly depend on whether there will be a recession or not. So in every recession in the past, I've just shown you, even if there's a temporary uplift in yields, it all comes down as the recession drags on. Whenever a recession drags on for too long, people, at least in the past, saw treasuries as a safe haven, bought treasuries, prices up, yields down. So in every recession, yields come down. If that's your scenario, the yields that you have now will not stay like that. But there's also a counterexample, the 2003 example, when the Fed cut rates, not much, but seemingly enough to avoid a recession, and treasury yields went up a bit and then stabilized. So really, that leads us to the next question. What does that mean for you and your treasuries? So what can you, as a Diamond NestEgg super saver who's looking to invest, do with your money? And this is explicitly for super savers, not for traders who think a bit differently sometimes. And clearly also, if you are with us, don't think that the increase in yield is a red flag. No, if it really was a red flag, you would probably think about something else. So that said, you have really three basic options. First, when you think the economy may be stabilizing, we may just muddle through, there will be no recession, maybe a soft landing, a weaker spot, but no outright recession. Or if you just want to maintain your flexibility, because you don't know what will happen, then you will stay on the short end. You will keep your money in shorter dated, shorter maturity treasuries, maybe T-bills, and see what happens. And if long end yields will go up later, you still have dry powder, so to speak, and can lock in those higher yields later when they come. So essentially it's an assumption, a bet if you want, the yields will go up again as the economy stabilizes. So if you are on the other side of the spectrum, if you think that a recession is coming, which may push yields down, or if you just maybe not think about a recession, but look at yields and think that they're still pretty attractive. Now, if you look at the past 20 years or so, something that we've shown you often enough on this channel, then you may just lock in those rates if you're happy with them and sleep well at night knowing that you're done. And then, of course, if you're neither here nor there, you can diversify, split your money. Buy some long-dated treasuries, but keep another part of your money in shorter maturities, T-bills, maybe even money markets or cash. So drop me a note below, share with me and the community how you interpret the rising yields at the long end that we saw after Wednesday. Is it a tentatively encouraging sign or is it a red flag? How do you expect the economy to develop? Are we going to see a recession, a soft landing, or maybe an immediate revival? And what are you doing with your treasuries and other bonds? Are you buying, holding, or selling? Or are you looking for diversification and maybe even alternatives outside of treasuries and bonds? So stay tuned on this channel. I'm looking forward to discussion. And for our members, I'm also really anticipating a lively discussion on our member live this Sunday. So all right, everyone, that was it for today. I hope you enjoyed the video and learned something new and hope to see you again soon.